Do you have any explicit election trades on, anything timed to coincide with November the 3rd or the days around it?
So I've been focused on trying to benefit from the rally in the credit market, which has largely lifted all boats other than fallen angels. And so what I'm trying to do in advance of the election is basically increase the position that I had on back in Q1, which is to say that the credit market is not distinguishing between vulnerable credits that are today in good shape and credits that no matter what happens are going to be in good shape. And I think basically there's too little differentiation in the credit market today, almost as much as there was 8 months ago.
How do you express that? Are you short bonds? Are you short single name CDS? Are you short CDS index?
Maybe all three.
Well, give me some examples then. Help to flesh it out.
Sure. So in the credit market, one of the interesting things is that through bonds, it's actually very difficult to be short. It's not impossible. Most bonds you could find some borrowability, so you could put on a short position, but the sizing for any significant fund of significant size is going to be pretty modest. And so one of the unique features about the credit derivative market, different from the bond market, is that in bond land, basically the company issues the debt, they sell the debt, the investors buy it, and the entire base of investors are long or they're not long, and there's almost no shorting. In CDS, every time someone goes short, someone went long. There's no company on the other side. It's a zero-sum game. And so as a consequence, that creates very different technicals should the market fall, because you have a lot of short sellers that are thinking about, should they monetize their gains? Should they leave it on? And in the bond market, instead, you have everyone on one side of the boat. And when the market sells off, you often have really poor technicals where people are all selling at the same time. So from that perspective, Erik, it would be good to have bond shorts, since they tend to perform well as a short compared to credit indices and CDS of single companies. But in reality, it's very difficult to reasonably put on a bond short of size. And so the most effective way for our portfolio to be short is through credit default swaps, both indices and single names. And where I favor being short is on fairly low spread CDS that just 6 months ago proved itself. It was a proving ground for what can happen. If you didn't widen a lot back in March, you're probably not going to widen a lot should there be a second wave of COVID. But there are some companies today that are trading at a mere third or quarter of the spread that they were at just 6 months ago, and not that different from where they were at their tightest levels. And so I think basically this enormous rally that the Fed has fueled, and of course the abatement of the virus, the lull that we had this summer, the reasons the market has rallied has given investors a second chance to consider reducing risk units to credit, which I strongly am in favor of, or even to taking on short positions as a hedge. Since the equity market, those hedges are extremely expensive right now. Equity volatility is almost inescapably high. When you think about, is it a good form of insurance, the payoff profiles are nothing like they were back in January, whereas in credit, we're almost back to where we were in January.